In 2019, a Chinese coffee company convinced Wall Street it was worth $4.25 billion. By 2020, investors discovered something stunning. The company had invented $310 million in sales. Not lost money, not miscalculated, invented, completely fabricated, fake. The stock price crashed 80% in a single day. Billions disappeared. But here's what nobody expected. This company didn't die. It came back. Not just back, dominant. Today, it has more stores than Starbucks, more locations than any coffee chain on earth, and it's planning to return to the same stock exchange that threw it out. So the real question is, how does a company admit to massive fraud, get kicked off Wall Street, and then come back stronger than ever? And more importantly, what are they actually selling? Let's go back to 2017. You're in Beijing. China is changing faster than anywhere on earth. Mobile payments are everywhere. Young people have money in their pockets, but there's one thing they don't have yet: coffee culture. Starbucks had already been in China for 18 years. They owned the market. 3,500 stores, complete dominance. They took a nation of tea drinkers and turned them into coffee addicts. But someone looked at that situation and thought, what if we could beat them? What if we could do something they couldn't? That person was Lu Jingyao, 32 years old, sharp, connected, and crucially, he had something most entrepreneurs don't have. He had already won. Lu wasn't starting from zero. He came from Schnavbar Zush, China's largest car rental company. He had been number 2 there. He had scaled a massive business. He knew how to grow. And more importantly, he knew people. Rich people. People with billions of dollars. In late 2017, Lu launched Luckin Coffee with a single store in Beijing. Just one kiosk. Customers ordered through their phones on a QR code. No line, no cash register, no humans involved. Just pure efficiency. But this wasn't a coffee business. This was a technology play. This was a company that understood something critical. In China, if you move fast enough and you have money, you can reshape an entire market. You can create demand out of nothing. And Lu had both, speed and money. What happened next was unlike anything the coffee industry had ever seen. In the first month, nobody noticed Luckin Coffee. It was 1 store, then 2, then 10. Then something shifted. By 6 months after launch, Luckin had opened 2,000 stores. Let me say that again. 2,000 stores in 6 months. Starbucks took 20 years to reach that number in China. Luckin did it in half a year. How? With the most aggressive pricing strategy in business history. A Starbucks coffee in China costs around $5. Luckin charged $2, sometimes $1, sometimes $0. They weren't selling coffee. They were buying customers. Think of it like this. Imagine you have a video game and you want millions of people to play it. You don't charge anything for the first month. You make it free. You get people addicted, and then when everyone's hooked, you start making money. That's exactly what Luckin was doing, but with coffee. Customers started downloading the app. They started coming back. The repeat purchase rate was insane. Better than Starbucks, better than anyone. And Wall Street noticed. In 2018, Luckin closed its Series A funding round, $400 million. The company was only 9 months old. That money came from some of the biggest investment firms on earth. Centurium Capital, Joy Capital, BlackRock. These weren't gambling on a dream. These were serious money people making serious bets. By May 2019, Luckin Coffee went public. IPO on Nasdaq, the same stock exchange where Apple and Microsoft trade. A Chinese coffee company, not even 2 years old, raising $695 million. The stock price surged 45% on day 1. It set a record, fastest Chinese company ever to list on the Nasdaq. Newspapers called it a Starbucks killer. Analysts on Wall Street were excited. Investors were convinced. This was the future. This was the company that would finally knock down Starbucks' empire. But nobody was asking the question that mattered. How is this possible? How is a company burning massive amounts of cash every single day, losing money on every cup of coffee sold, and yet convincing the world's biggest investors that it's worth billions? The answer is simple. They lied. Here's what was really happening behind the scenes. When you run a business, you report numbers, revenue, profit, customer acquisition costs. These numbers are supposed to be real. They're supposed to be auditable. They're supposed to be truth. But what if you just made them up? In Luckin's early days, the numbers looked incredible. By 2019, the company reported that it was selling 400 to 500 cups of coffee per store per day. Wall Street believed it. The numbers were published in official financial statements, certified by auditors. It had to be true, except it wasn't. Here's how the fraud actually worked, and it's simpler than you'd think. Luckin would identify partners, business associates, even employees. Then through these partners, fake orders would be created on the app. The money would move around in circles. Partner gives money to Luckin. Luckin records it as sales. Luckin gives the money back to the partner through payment for supplies or marketing. The cash comes back to Luckin, but the sales revenue stays on the books. It's circular, it's fake, but on a financial statement, it looks real. And because it's buried in millions of real transactions, it's almost impossible to detect. By early 2020, the company had faked approximately 2.2 billion yuan, roughly $310 million in sales. That's not a rounding error. That's not an accounting mistake. That's nearly half of what they claimed to make in 2019. It never happened. Every number was invented. But why would a company with billions in funding do this? Why take the risk? The answer is the same reason someone climbs a mountain, because the mountain is there, and because once you start climbing, stopping feels like failure. Luckin had raised billions. Investors expected growth. Every quarter had to be bigger than the last. The stock price had to keep climbing. And when the real business couldn't keep up with those expectations, when real customers weren't buying enough coffee, the solution was simple. Fake the customers, fake the sales, keep the machine running. The pressure doesn't excuse it, but it explains it. In January 2020, someone started asking questions. His name remains anonymous, but his weapon was unusual. The man who exposed Luckin wasn't a regulator or an accountant. He was a short seller. These are investors who profit when companies fail. They have an incentive to trash businesses, so nobody takes them seriously. But this short seller was different. He was methodical. He published an 89-page report, and instead of just making accusations, he provided evidence. He hired 92 full-time investigators. He deployed 1,400 part-time workers. He sent them to stand outside 620 Luckin stores across China. For months, they recorded video, they counted cups, they collected receipts, they gathered over 11,000 hours of surveillance footage. The data told a story that contradicted everything Luckin had reported to Wall Street. Luckin claimed stores were selling 400 to 500 cups per day. The investigators counted maybe 200 to 300. When you place an order at most coffee shops, you get a receipt number. 100, 101, 102, 103. Sequential. But at Luckin, the investigators found something strange. Numbers would skip. Order 100, then 103, then 107, then a jump to 150. As if orders were being deleted or never happened. The report was published by Muddy Waters Research, a short seller firm. The stock dropped 20%. But then something unexpected happened. It recovered. Investors didn't believe the report. Why would they? Luckin was the future. Why would they side with a short seller over a hot company? Luckin denied everything. The methodology is flawed, they said. The conclusions are inaccurate. For a moment, it seemed like they might get away with it. Then 2 months later, in April 2020, Luckin's own accountants, Ernst & Young, refused to certify the company's financial statements. Something's wrong, they said. We can't verify these numbers. Under pressure, Luckin admitted everything. The CEO had created fake sales. Other executives were involved. The company had fabricated $210 million in operating profits. The revenue numbers were completely false. When the truth came out, it wasn't a gradual decline. It was a collapse. The stock price didn't slowly fall. It crashed. On the day of the admission, it lost 80% of its value. $5 billion in market capitalization evaporated. Gone. Investors who had bought at the IPO at the peak of excitement watched their money disappear in a single trading session. The Nasdaq delisted the stock. Luckin was no longer welcome. The SEC fined the company $180 million. Shareholders sued. The company agreed to pay $187 million in settlements. And then it should have ended. That's how the story usually goes. The fraud gets exposed. The company disappears. The executives disappear. Everything gets sold off. Gone. But Luckin didn't disappear. Something strange happened instead. A private equity fund called Centurium Capital, one of the original investors, doubled down. Instead of abandoning the company, they put more money in. $240 million. They brought in new management, a CEO named Guo Jinyi, who had been running operations behind the scenes the whole time. He wasn't part of the fraud. He understood the actual business, and Centurium made a bet that changed everything. They believed that the fraudulent numbers weren't the only numbers that mattered. Yes, the executives had lied about sales, but the thing underneath the lie was real. Real customers were walking into real stores. Real people were downloading the app. Real demand existed. The fraud was on top of something that actually worked. So they did something radical. They fixed it. They fired the fraudsters. They brought in new people. They focused on real profitability instead of fake growth. They closed unprofitable stores. They cut costs. They started experimenting with new products tailored to what Chinese customers actually wanted. In April 2021, they launched the coconut milk latte. It became an instant sensation. Within months, Luckin went from bankruptcy-bound to profitable. The company started making real money, real margins, real growth, and slowly the stores started multiplying again. But this time, it wasn't a lie. It was real. By 2023, Luckin had passed Starbucks in total revenue inside China. For the first time in 24 years, Starbucks was not the coffee leader in China. By 2024, Luckin wasn't just ahead. It had lapped Starbucks. 30,000 stores, more locations than any coffee chain on earth, more than Starbucks and Dunkin' combined in the United States. Starbucks, the company that had created China's coffee culture, was now the second player, and they were losing ground every single day. But here's what makes this story even more interesting. Luckin's comeback wasn't just about fixing operations, it was about discovering what the company was actually built for. Luckin isn't selling coffee, it never was. Think about this. A Starbucks is a location. You go there, you sit, you pay. You get coffee. The business model is straightforward. The coffee is the product. The store is the delivery mechanism. Luckin is completely different. When you order through the Luckin app, you're not just buying coffee, you're feeding a data machine. Every order generates information. What you bought, when you bought it, where you were, what promotion worked on you, your neighborhood, your preferences. The algorithm learns. Luckin has 290 million registered users in China. Every single one of them is sending data into a system that understands what consumers want better than any traditional company could ever hope to. That's why the coconut milk latte happened. It wasn't invented by a genius barista. An algorithm noticed that women between 22 and 28 in Beijing were rejecting traditional espresso drinks. They wanted sweet, creamy, tropical. The algorithm figured it out. 300 million cups later, that drink alone generated more revenue than most independent coffee chains make in their entire existence. The Muddy latte, a drink made with China's national liquor, sold 100 million yuan on its first day. Not because it was a good product, because the data said it would work. Starbucks tests new products for 6 months before launch. Luckin shipped 120 new drinks in 2024 because the algorithm decides what works. No guessing, no tradition, just data. That's not coffee. That's surveillance capitalism with a cup. And the franchise model reveals something even darker. Luckin advertises a zero-fee franchise program to attract operators in smaller cities. Sounds generous, right? But franchisees have to buy everything from Luckin. Machines, beans, milk, syrups, cups, software, everything. They think they're opening a coffee shop. They're actually becoming customers for Luckin's supply chain. A recurring revenue stream that has nothing to do with the actual coffee being sold. This is why Luckin could come back from fraud. The underlying machine wasn't broken. The fraud was just noise on top of something that was already working. And once the noise was cleaned up, the machine just kept running. Faster, smoother, more efficient. So what do we take away from the story of Luckin Coffee? First, the obvious lesson. Fraud is real. It happens at companies with billions in funding. It happens at companies run by smart people. It happens when the pressure to grow becomes more important than the truth. When stock prices matter more than reality. When quarterly earnings become the only metric that matters. The pressure is real. It's insidious. And it corrupts. Second, modern fraud is invisible. An old-fashioned fraud, a fake Rolex watch, a false financial statement. You can see it if you look. But Luckin's fraud was buried in millions of real transactions. It took 92 investigators and 1,400 workers standing outside coffee shops to expose it. Most fraud, if it happens at that scale, probably never gets caught. Third, the worst thing that happened to Luckin wasn't the fraud. The worst thing was that the underlying business model was sound. That's what allowed it to come back. If Luckin had been a fundamentally broken business with no real customers, it would have died. It should have died. But because there was something real underneath the lie, it survived. And fourth, Starbucks lost at China not because of fraud. They lost it because Luckin understood something about the market that Starbucks refused to accept. That Chinese customers cared more about price and convenience than about the experience. That the future wasn't premium coffee served in a beautiful space. The future was cheap coffee delivered through an app. And the real business wasn't coffee, it was data. Starbucks was playing the game of 1999. Luckin was playing the game of 2024. When you compete against someone fighting a different war, your weapons don't matter. Luckin Coffee is now preparing to relist on the Nasdaq. The same stock exchange that kicked them out 5 years ago for fraud is preparing to welcome them back. The company that built its empire on fake numbers is now planning to go public again. And the strangest part, Wall Street is ready to let them, because this time, the numbers are real.